Welcome to Money News. I'm Kathleen Walter. Joining us now is renowned economist Robert Wiedemer. He's the co-author of the book Aftershock, Protect Yourself from the Next Global Financial Meltdown. And he's also a regular contributor to the Financial Intelligence Report. And Bob, so good to see you again. Thanks for joining us today.
Thanks for inviting me.
Sure. Well, Erskine Bowles and Bill Pimco say that a U.S. default would be catastrophic. Warren Buffett says the United States will go right up to the point of extreme idiocy, but we will not cross it. Do you think everyone will come to their senses before it's too late?
I don't know if they'll come to their senses. That's going a bit too far. But will they not cross it? I agree with Warren Buffett. They won't. We will get through this. But what's interesting is how much we might push it. And there is some long-term damage from this. We've had problems before, fiscal crises before. We're having a budget crisis now. We're printing $85 billion a month, and we're borrowing massive amounts. It may be a bit less than before, but still $600 or $700 billion is a massive amount. This all, I think, takes away from the financial credibility our nation has built up for so long. It takes away bit by bit. But no, I don't think we're going to cross it.
So what kind of harm is this debate in Washington causing the economy?
Well, short term, not a lot. Well, and even in D.C., they're having, I think it's shots called shut down the government, shots of whiskey. I'm not saying we're all celebrating, but I don't think the short-term effect is that much. But as everybody knows, if it goes on for a few more weeks, that's different. And of course, if we actually did in any way default on the debt, well, that's massive. But I think the short-term effects are going to be relatively moderate, and I do think within a few weeks, hopefully, we'll get some resolution to this.
Let's talk about the economy. Do you see it struggling to maintain steady, stronger growth? How does it look to you? What's your assessment?
Well, what's steady, stronger growth? I mean, we're maybe growing 2% a year right now. That isn't really all that good. We haven't bounced back all that much. There's talk about a recovery, but there hasn't been that much of a recovery. Even in new home building, we're still at near record lows for the past 30, 40 years of new homes being sold. So that's single family homes. So I mean, there's been some recovery. I wouldn't go overboard on that. And as I always say, keep in mind, this recovery is not a real recovery. It's very much financed by government borrowing and government money printing. Since the financial crisis, we have still borrowed more money than our entire economy has grown during that period. So let's put it all in perspective. This isn't some sort of recovery out of the blue or normal. It's very much a government-created recovery.
And it seems that President Obama has bought into the so-called wealth effect theory. If he keeps interest rates low and forces cash into the equity markets, the stock market grows in value and people feel wealthier and continue to spend. Is this a sound way to bring about a recovery?
Well, what do you think? The reality is, no, I don't think so. Manipulating the monetary system or whatever is not a sound way to build any economy. Yeah, it has worked. The stock market's up. Actually, the spending resulting from that hasn't been quite as strong as I think some people expected, even on the high end. It's been stronger, yes. But let's face it, this economy is still driven a lot by the rest of America, and they're not benefiting from those high interest rates. They're suffering. I mean, the lower interest rates, they're suffering to some degree, and they're certainly not benefiting from a big rise in the stock market. So, no, it's not a sound way to build an economy. You build an economy, obviously, by increasing efficiency, productivity, and so forth. That's how you do something that lasts. Financial shenanigans, no.
Can the American consumer ever expect conditions that will allow incomes to begin keeping pace with the actual increase in the price of goods and services that they need on a daily basis?
Well, I think we've already answered that question by printing $85 billion a month. You're eventually going to get inflation. I mean, how do you do this year after year after year and not get inflation? It will happen. So I'm afraid that problem will solve. Now, are we going to improve our quality of life? Absolutely. But we got to focus back on what's improved our quality of life over the last 200 years. Productivity increases, not financial finagling and money printing. Not going to work. Short term, maybe, but not long term.
And what about unemployment? Where do you see the unemployment rate by the end of the year?
Probably not much change. In fact, it could even go lower, especially if more people drop out of the workforce, which has been one of the big drivers for the lower unemployment rate. People have just dropped out of the workforce. So fundamentally, unemployment rates are not necessarily showing you exactly what's going on in the employment situation.
Yeah, is this a valid metric in determining the overall health of the U.S. economy?
I don't think it is that valid. And in fact, the Federal Reserve itself even mentioned that just looking at unemployment rate is not necessarily giving us a true reflection of the state of the jobs market in our world. Certainly young people are having a lot of trouble getting good jobs. I'm not saying people aren't getting jobs, and it's a bit of an overstatement to say they're all hamburger flipping jobs. They're not, but they tend to be lower wage service jobs, and that's what most people are getting. It's not that strong of a jobs recovery in terms of the quality of the jobs, the pay of the jobs, and especially jobs for younger people. So I think it's an okay metric, like any metric, but it's getting somewhat increasingly misleading.
And the budget showdown in Washington. Has this impacted the Fed's decision to taper at all?
I think if anything, it's going to make them less likely to taper. Obviously, they're not likely to taper right now. They don't even feel they could taper $5 or $10 billion. On an $85 billion purchase, they don't even want to go down to 80 or 75 billion. So they're pretty scared of tapering anyway. And I think they make no indication they're going to change anytime real soon. So if anything, it's just simply encourage them to keep the money presses rolling.
And what about Janet Yellen? Do you like her for our possible next Federal Reserve chair, or would you rather see somebody else?
Well, yeah, somebody else was Larry Summers. I get to nominate people, so the only two choices right now were those two. Larry Summers has pulled out. So it's going to be Janet Yellen. And what I can say is she's Ms. Money Printer. So if anything, that means that we're more likely not to see tapering next year because of that. Who knows? Maybe even this decision not to taper was influenced in part by her becoming more likely the presumptive nominee when she I think, will take office January 31st. So I think in some degree who gets to be the Fed chairman is somewhat of an unimportant question, because I think both, whether it's Summers or Yellen, they're going to print a lot. Yellen might print a lot more, but I think they're both going to follow policies that have already been established for a while now and will continue.
Let's chat for a second about Europe. George Soros says the European Union remains at risk of collapse. Do you agree with his assessment?
Well, I don't know. What do we mean by collapse? I mean, France and Germany are still going to be trading with each other, right? They're right next to each other. So that's not going to collapse. The problem with the euro is more of a debt problem. It's not a euro problem. I've always said if we just got rid of the euro and we changed to pesetas or drachmas or back to lira for Italy, is that going to solve the debt problem? Oh, I'm sure the German banks will love getting paid back in Italian lira, right, instead of euros. So I think it's a little less of a euro problem and more a fundamental debt problem that they've got. And will their economy collapse? Well, their economies in Greece and Italy are already pretty collapsed. So yeah, could it get worse? Of course it could get worse, but I don't think that's going to happen immediately. And certainly, no, the union itself doesn't collapse in the sense that they're obviously going to be trading partners for as long as we can foresee.
And getting back to here in the U.S., you in the past have predicted that we're on the road for 10% inflation. Do you stand by that prediction? The U.S. government says that inflation remains relatively low, but prices of oil, food, and commodities suggest otherwise. What's your take? Well,
I think people's wallets suggest otherwise, too. You just asked the question. People are not feeling like their pay is going up with the cost of goods. We know that healthcare is going up a lot faster than inflation. Education is going up a lot faster than inflation. These are the real expenses that people have to make, and they certainly don't feel like they're not inflating. So I think the government is incorrect on its amount, and yes, I do hold to my 10% prediction. I think it will go beyond that. I don't even say that's a prediction. I say we've already made much of that decision. We're up to $3.5 trillion now in our monetary base. That's a huge increase from $800 billion before the financial crisis, and we're adding $85 billion a month. If it's not going to do inflation or create inflation, my God, why don't we triple that? Why don't we print $250 billion a month? If it's doing anything to help the stock market, anything good, and there's no downside, why don't we do more of it? I think people know more than what they're saying. They know, of course, it will create some sort of problem, and that's inflation. We know it. Otherwise, we could just do a whole lot more of it and just have a great economy.
And Bob, last question for you. Assuming we get this budget showdown behind us, where do you see stocks and gold prices headed?
Well, it'll be interesting because I would have thought, honestly, that after the decision was made not to taper, not to reduce money printing, the stocks would have jumped a lot. Well, they did jump a lot the first day, but within the next few days, they went down. So obviously, the stock market seems to be losing a bit of its old animal spirits. Could I see, once we get past this budget crisis, a relief rally where everybody goes, cheers, it's behind us, and we run to 16,000 on the Dow? I could see that. But what's happened in the last couple of weeks worries me a little bit, so I'll be on the lookout to see how much of a relief rally we get. I mean, remember, earnings growth is way behind stock price growth. Certainly revenue growth, GDP growth, all behind stock price growth. At some point, it's going to catch up. And even further down the road, at some point, this market will fear money printing, not cheer it.
All right, Bob Wiedemer, thanks for joining us.
All right. Thank you, Kathleen.
And thank you for watching Money News.